affect or threaten, the life that they are envisioning for themselves when they're done working. So with that, I'm just going to do a little housekeeping here. If you have any questions, please do type them into the question box that you have there on your screen, and I will make sure to address those at the end. And without further ado, Matthew, you can take it over. Thank you for being here with us today.
Allie, thanks for having me. Thanks everybody for joining. And like Allie said, these are unprecedented times and rather unique. Hopefully everybody's staying safe, and we'll try to provide a little bit of content today with regards to long-term care. It's something that Nationwide we feel like we do very well at Nationwide, and one of the subjects, or I guess one of the prospects, kind of a harder clientele to break into is with the affluent clientele, and there's a lot of misnomers, if you will. There's a lot of misunderstanding with regards to long-term care. And so hopefully we can give you some tips, some ideas to where it'll make that conversation with your high net worth clientele or somebody that you're approaching to try to make a client, to make that a little bit easier. So with that, let me get started here. So one of the first things that we see when we're talking to the high net worth clientele is a lot of times we see that high net worth client spending a little more on healthcare currently, and a lot of times as a result of that, they are in a little bit better health than the normal client that you might encounter. And while a lot of people think that because they're in very good health now, they are unlikely to need long-term care or less likely to leave long-term care or need long-term care, it's actually the opposite. Generally, if you are healthier, you're probably more likely to need long-term care because you're going to live longer. And because you're healthier, once your facilities, once your faculties start to decline a little bit, but because you're healthy, you're going to be more likely to live a little bit longer and to hang on and be able to manage that better than someone that is not in as good of health as you would be to start with. So one of the first things that we find is that the affluent clients that are in good health, they think because they're in good health, they're not going to need care, or they're less likely to need care. And again, we're finding that it's the opposite there. So the other thing that we find with the cost of long-term care in the affluent is that the people that are affluent, they buy the best, or they're more likely to buy the best. They've got the means, they've got the funds to pay for better care. They've got the funds to pay for a private room versus a semi-private room if they're in a nursing home. They've got the funds to pay for a better home health care provider, or a home health care provider for longer hours, more hours throughout the week. And so, that's another thing that reps should consider as they're talking to their clients, because again, just because they have the funds to pay for this doesn't mean that they necessarily should with their own assets. So one of the trends we see is spending more on healthcare and long-term care expenses. So this is always a fun one, is that with long-term care, the tradition and the conversation has always been centered around the risk of needing long-term care and the importance of ensuring that risk. And I'll throw out a stat that I'm sure all of us that have attended more than one long-term care webinar or seminar has probably heard before. 70% of people over the age of 65 will need some form of long-term care. Well, when I throw that out, and I'm in a large meeting room, and I throw that statistic out, I try to have some fun with it, and especially with the men. I'll ask the men, okay, which of you think that you will need long-term care? And of course, either no hands go up, or the guys that respond, they point at the people next to them, and no one points to themselves or raises their hand. So it's kind of funny is that when you start to talk about risk, the challenge with that is most people have a hard time insuring a risk that they don't see occurring, insuring an event that they don't see as a possibility of occurring. And so that's where that conversation can be a bit of a challenge, is if we're talking about risk, especially with men, they really don't see the need to insure something that they don't think will happen. So same thing with affluent clients, is that a lot of clients think because they're in a little better health that they're not going to need care, or clients believe that, and they probably can, they're probably right, that they can afford to pay for care out of pocket. So what we think a better approach is to discuss the consequences of not insuring against a long-term care event, insuring for a long-term care event. Discuss those consequences, not the risk. So let's take a look at what that might be. We are, as luck would have it, we are in the middle of a market downturn, right? For years I would have this conversation and would talk about, if another subprime mortgage meltdown like in 2008 occurred, if the market took another dip like 2008, well, we are right in the middle of that. And so that can present a challenge with regards to just that emotional aspect of trying to withdraw money in a down market. If a client were to need care right now, they would certainly have to liquidate more shares of a certain investment right now, because the value is very likely significantly less than it was just a month ago. So that can be quite a challenge. And then if you have to withdraw in a down market, that's something that can take even longer to build back up, to pre-market downturn levels, if at all possible. And so what we like to say and what we like to recommend is not necessarily discussing this as a risk type of thing, but again, more of a, do you believe it could happen? And if it were to happen, what would be the impact, or what would the consequences of trying to liquidate assets, liquidate investments in a down market? For some people, it may not be much financially. They may be well enough off. They may be wealthy enough that it's not going to impact their spouse, their children. But for others, that could have a significant impact. And one of the major impacts in kind of that emotional side of things that is a draw or a motivator to move on long-term care planning would be that impact that it could have on a spouse or children. So if someone were to have to spend down their source of income in retirement to pay for care, that can be a major motivating factor, if you will, especially for men. So our solution and what we try to look towards and work towards is, let's see if we can try to find an asset, try to find a product that can create a dedicated stream of income. It's not tied to the market. It will be readily accessible. It will be cash flow for you when the need arises. But again, it's not going to be impacted by the market. It will be a guaranteed benefit, and again, will be independent of current market conditions. And we talked about this just a little bit ago, but again, it may be hard to build back up to previous market downturn levels, to build those assets back up to previous downturn levels, if you have to take a withdrawal during a dip in the market. And so as the advisor, what I like is that kind of lower right thought bubble, if you will, is that it's your job as the advisor to try to discuss ways to help protect and grow their assets. And what's really nice, when you're talking assets and asset classes, we'll go over this in a little bit, but the style of benefit that Nationwide pays for their long-term care claims it really lends itself to being considered an asset class. We pay a cash indemnity style benefit. And so what's really nice about that is there are no restrictions. So here, let me show you what the differences are here. So with a cash indemnity benefit, what will happen there is the carrier will pay a full benefit for long-term care. So they will pay 100% of the benefit that the client is eligible for as soon as they qualify. Same qualifications, same 2 out of 6 activities of daily living. But what's really attractive, especially to that high net worth clientele, is that there's no fine print. There's no requirement on how this money can be spent or saved. There's no requirement that a care provider be a licensed care provider. There's no restriction on can this be spent for home health care or does it have to be nursing home. There's literally no fine print. It is qualify for the benefit, qualify for the claim. Here is your monthly benefit. You decide what to spend it on. So that's a really nice advantage, especially for that high net worth clientele. The other option, and probably more common option, is a reimbursement model. And the way the reimbursement model works is that the client will incur some sort of care, and then they will generally pay for it and receive a receipt, an invoice, and then submit that invoice to the carrier. Sometimes it's on a monthly basis. Sometimes they may need to only set it up one time, and then the carrier and the provider will start to talk to each other and bill each other directly. The challenge with reimbursement is that there's a limit to what's covered. And unfortunately, I can't give you this broad-based limit and what's covered and what's excluded for every policy. I can give you a rule of thumb. So with the reimbursement model, the general rule of thumb is if it's direct medical care for the insured provided by a licensed professional, that is generally reimbursable. There are some other instances outside of that may fall in line with to allow for reimbursement, but sometimes there's some fine print. One of the exclusions that I hear very commonly is that prescription medications are often not reimbursable. And while if someone is on Medicare and they have a Part D for prescription drugs, that's certainly something that can help, but Part D is only going to help with formulary drugs, and there's still a copay. So the challenge there is that the copay may be very reasonable and very inexpensive, or the copay may be $1,000 a month, or maybe that drug is not even on the formulary list or the covered list, and it might be deemed experimental, which then would not be reimbursable. So the reimbursement is not quite as clean as the cash indemnity style of benefit, but just wanted to make sure that everybody was educated on those two. So what is one of the ways that can be easy to talk to the clients, get the conversation started? Nationwide offers, and you can work through CORE to receive this fact finder, but Nationwide offers a customized healthcare and long-term care assessment. And so this fact finder that you're viewing right now is pretty quick. I have sat in meetings, and it takes about 2 minutes to complete this fact finder, and then you can submit that back to Nationwide through CORE. And what will happen is Nationwide will generate a cost of care estimate for your client. And it's really nice because it can be both the cost of healthcare and the cost of long-term care, or it could be one or the other. But it will factor in just some basic current health conditions. It will factor in some planned income in retirement for us to be able to understand what tax bracket you might be in. And again, it will give a nice estimate both for healthcare expenses and long-term care expenses. That is something that is free of charge from Nationwide, and something that we also do not require that a nationwide product be written as a result of this. We hope that a nationwide product is written as a result of this estimate, but it's not a requirement. So what I've seen, sometimes I've seen some advisors use this. We're in a heightened kind of fiduciary responsibility environment now. And so I've seen some advisors use this as kind of their proof that they have discussed long-term care. It's kind of their hedge against an E&O claim. They've discussed long-term care. They've presented a need. They've shown a cost estimate. They've presented solutions, and the client opted not to go with this. But I've seen financial advisors use this as, again, just as a safety net for them to make sure that they're covered should family members generate any type of litigation on down the line. So with this, what are options to plan for care, and what type of products are available? So for the longest time, we generally saw this first one, this traditional long-term care policy. And while this approach probably provides the most bang for your buck in terms of the most long-term care coverage for $1 of premium, there are some common objections to it. And, the first and foremost is that it only pays for long-term care. And so what we mean by that is if somebody passes away without needing care, there's no death benefit associated with those contracts. Premiums are not guaranteed, so they are subject to potential future rate increases. And I have heard everything from a small, minimal 10 to 15% rate increase to a 75% rate increase. And it's really hard to tell. It's hard to predict. Unfortunately, the client is just at the mercy of the insurance carrier and how well they priced and predicted and underwrote the product initially. And then also, they've become quite limited with regards to premium payment schedules. And so they've morphed into generally just a lifetime premium payment. So you don't have a whole lot of flexibility or opportunity to short pay those designs. And then lastly, and it's not on here, but it's an advantage to some of the other contracts, is that if a client changes their mind in the middle of the contract and wants to walk away, there's generally not a return of premium feature on the traditional long-term care policy. But again, I think the biggest selling point for those is that it offers the biggest bang for your buck. You can really dial in some strong coverage there. The other option, and this is one that Nationwide offers, and a lot of carriers have joined in as well, is that it's a traditional life insurance contract. So think GUL, think Index UL. Those are probably pretty attractive right now for cash accumulation with what's going on in the market. Think variable UL. So a traditional life insurance policy with a long-term care rider. And the way that those work is you add the rider to the contract, and the client will elect an amount up to the death benefit to be available for acceleration. It's not a separate pool. It's the same pool. It's the same policy. And the client has the option to start to spend down their death benefit. And pretty common in the industry is a 2, 3, or 4% acceleration. So to put that in numbers for you, if you've got a $500,000 death benefit, the client would have the option to spend down $10,000, $15,000, or $20,000 on a monthly basis. And then whatever, if the client passes away, whatever has not been spent for long-term care is then paid out as a death benefit to the beneficiary. So it's really nice. It's a dollar for dollar spend down. If the client goes on long-term care claim for, say, $250,000, they pass away, there's a $250,000 death benefit remaining that is paid out to the beneficiary. So that's very nice. And there's total flexibility in premium schedules. These are products that can be designed anywhere from a single pay all the way to a monthly pay to age 120 type of design. So they're very accommodating to all types of different clients. What I would say, these seem to be attractive to the clients. Men tend to be drawn more to a life insurance with a long-term care rider because, again, you think back to that risk that I talked about earlier, is that we tend to think we're not going to need care, but we know that we're going to pass away at some point. So we tend to be drawn to the death benefit component of this approach. The other option, and this has become very popular in the industry probably the last 5-10 years, is what we call a linked benefit policy. And this is kind of the opposite, if you will, of that life insurance with the long-term care rider approach. While technically a life insurance contract, really the design of this one is to have a very minimal life insurance death benefit, but a very significant long-term care benefit should that need occur. And that's one of the major attractions, is that we can really leverage a lot more for long-term care with this approach than we can with the life insurance with long-term care rider. But then it's got some features that can address some of the concerns that people might have with a traditional long-term care policy. So there's a death benefit if care is never needed, or if somebody goes on claim and dies very, very early in the claim. The premiums are guaranteed. And so everything about this contract is a guarantee feature. So the return of premium component is guaranteed. The death benefit is guaranteed. The premium, if they choose some sort of annual mode, that is guaranteed. The inflation option, everything about this is guaranteed. So that can provide some comfort to those clients that the carrier can't change the terms later on down the line. And then we do have some flexibility with regards to paying premiums. We've got options now in the industry between single pay all the way out to pay to age 100. And I think in the first 15 years or so, 20 years of these types of contracts, they were very heavily focused as a single pay contract. And, while for the affluent clientele, hey, they've generally got that flexibility. They've got some cash sitting around on the side, maybe something they even thought they were going to earmark or had earmarked for care. But now, these things have been designed to where they can look a lot more like a traditional long-term care policy. Again, we can pay all years all the way to age 100. We can pay it as short as a lump sum. So there's some flexibility there with regards to the design. And then this last slide here, what I wanted to talk about, Nationwide, our version, our linked benefit product, our competitor to Lincoln MoneyGuard, if you will, it's called Care Matters. And we're on the second version, so Care Matters 2. And we launched this last year in May. We launched this version last year in May. And so I wanted to show this slide because like some other carriers, we've got a couple of tweaks here that we're going to be making, but I felt like I could verbalize those to everybody versus try to show you some of the outgoing opportunities, if you will. So the payment options, we offer a single pay, a 5 pay, a 10 pay, a pay to age 65, and also a pay to age 100. Previously, we did not allow for 1035 for any mode other than a single premium, and we have loosened that restriction, and we now allow for 1035 in addition to a flex pay design, if you will, in addition to a 5 pay or a 10 pay and so forth. We've added additional inflation options. So currently, this product offers 3% both simple and compound inflation protection. There is a 5% compound inflation option. And then there is, we're calling it the U.S. medical care. And the very short version of this is that it is a floating rate between 2% and 6% that is based off of the medical component of the consumer price index. So that rate will adjust up and down based on actual medical inflation, and will reset from time to time. So we now offer, I mentioned that these contracts have return of premium options, and so we now offer 3 different options. One is a vested option that ends up with, after 6 years, 100% return of premium. The other is a step-up option that is 80% return of premium for 10 years, and then it jumps to 100% beginning in year 11. And then the last and probably most popular, this is one that we probably see 80% of CareMatters policies being issued with, is a cash surrender value option. So that's going to offer the lowest return of premium, but the trade-off is it offers the biggest bang for your buck in terms of long-term care benefit that you can purchase. And there's such a small percentage of these contracts that are ever surrendered and where they exercise the return of premium option, that we thought that was pretty important to give the client the opportunity to take less return of premium potential in order to buy more benefit. We have tweaked our elimination period, enhanced it for the client. It's a 90-day elimination period. However, once it's satisfied, we will pay a retroactive benefit for those 3 months. So essentially, if someone goes on claim, the first benefit check they will receive is for 4 months of benefit. The 90 days retroactive plus the first month that they would qualify for. And then lastly, this is one that, if interested, we can certainly go into some more detail on this in the Q&A section, but we built this product with separately identifiable premiums. And what that means is there's a very dedicated, very specific premium for the life insurance component. And then there are 3 different premiums for all 3 of the long-term care components. So the long-term care rider, what's called the extension of benefits rider, and also the inflation protection rider. And the reason that we did that is that allows both the individual client, the individual insured, as well as any corporation. It will allow for potential tax deductibility, potential health savings account distributions. And so it allows for a little better planning, if you will, when it comes to long-term care from a tax standpoint. So that's a new feature this year, and we really like that. We're really seeing a lot of traction with that. So one thing I have not mentioned, and I'll make sure that I mention that with CareMatters too, the issue ages will range from age 30. We can issue as young as age 30, and effective 2 weeks from today, the maximum issue age will be age 69. So that's one of the tweaks that we're going to have to make to this contract in light of current economic conditions, is that we're going to restrict the older ages, the older clientele from applying for these contracts. But still, age 69 will be the maximum issue age. So with that, I will pause. Allie, I appreciate it. Are there any questions? Does anybody have anything that I can try to answer here?
Yeah, we did get a couple questions pop through. The first one was, what if a client does not need the full benefit in a month on a new contract that has inflation? And the example was, client has $10K benefit, but only wants to take $5,000 and then leave the rest in the contract. How does that work?
Yep, that's a great question. So I will answer that. I'll answer that completely, but there are a couple of parts to that answer. First, the way that our inflation rider works is that in order to qualify for any inflation benefit, the client first has to elect their entire base benefit. So if they've got a $10,000 monthly benefit and $7,500 of that is base benefit and $2,500 is inflation, they have to elect the full $7,500 in order to qualify for the $2,500 of inflation. The other part to inflation is that any inflation benefit that is not elected in a given month is permanently forfeited. So in this example, if the client were to elect $5,000, then that $2,500 portion for inflation that month is permanently forfeited. That doesn't mean they're ineligible for inflation the next month. That just means they've given up that month's inflation option or inflation, those dollars forever. And then lastly, what I would say on this is that because it's a cash indemnity style benefit payment, again, we have no restriction or requirement on how this can be spent or saved. So it's actually a benefit to the client to take the full benefit that they are entitled to. And if they only need a portion of it, that's fine. Save it. We allow for that to be saved in a personal account. We allow for that to be saved in a brokerage account, something that you, the financial advisor, might manage. That's fine. But take everything you're entitled to from the minute you are entitled to it, because some of it, if you were to leave it in the contract, it could be forfeited permanently. So I hope that answers the question.
Yeah, that sounded pretty clear to me. One other question that came through, I think it's more of like a generality, if you can make a generality about this. Are linked benefit LTC policies generally more expensive than life with the LTC rider?
Yeah, yes, I can attempt to answer that. So I'll give kind of a both scenario type of question. So if you're looking to buy maximum long-term care benefit, what I've seen is that in most scenarios, you can buy a larger pool for long-term care with a linked benefit contract. The trade-off though is that the death benefit is not quite as high. We have seen some situations where young healthy insureds can buy a little more with the life insurance and the rider approach. But for the majority of people that are going to start to think long-term care, so I would say think 50s until mid 60s, a very high percentage of the time we are seeing more coverage for long-term care with a linked benefit contract.
Awesome. Thank you so much. I'm not really seeing any other questions pop through. Matthew, do you want to make mention of the continuing education?
Oh yeah,
everybody?
Yeah, I would be happy to. Yeah, so everybody, I appreciate you joining. And if anybody needs continuing education, please reach out to Allie. I nationwide can sponsor and provide a voucher for you to take one course online. That would be online at your desk at your home, and it can be anywhere from 1 hour of credit up to 20 hours of credit. So you will have an entire library and an entire catalog to choose from, and you pick the course that's best for you and the amount of hours, and go from there. So I appreciate it. I like telling the long-term care story, and I figured that in-person continuing education was probably not going to be available for most of us for the near future.
We so appreciate that. And everyone, my email address, if you need to reach out, is apeters@coregroupusa.com. Again, apeters@coregroupusa.com. Matthew, thank you so much. We really appreciate you going over this with us today. And thank you everyone for tuning in. Our next webinar is April 16th, and it's a Thursday at 1 p.m. again. So hope to see you there. And we appreciate you. Stay safe and healthy, everyone. Thanks, Matthew.
Thanks, Allie. Have a good one. Everybody stay healthy.
Bye.